Hi everyone, it's 11:30, so let's get started. Welcome to this monthly webinar. My name is Henrik Andersson. I'm the CIO of Apollo Capital. And as you probably know, Apollo Capital is an actively managed crypto fund. Um, we are open to wholesale investors, and the minimum investment in the fund is 50,000. And we are doing this kind of webinar every month. And we will end with a Q&A. And as you probably see, there is a chat box next to this video where you can ask questions. So we love questions, and please ask as many questions as you like. We have an open door policy, meaning that we like to be very open, and we are always open for you to ask questions through these webinars or through emails. So please contact us at any time if you have any questions about the crypto markets or what we are doing. Today I'm going to talk about recent events in the crypto markets and some news flow and some interesting developments on the tech side, and then we go to Q&A after that. As you probably have seen, the crypto market has declined quite a bit in November. The crypto market cap is down to 118 billion in total market cap. And for Bitcoin, we've seen a recent decline as well. Bitcoin traded at 5,900 or so in first or second week of February. It reached that level again at the end of June, and then the recent market decline led to Bitcoin trading at 3,500 a few days ago. It's now up about 4,000 again. The last 24 hours has been pretty bullish in the market, but I think it's worth talking about our thoughts on this decline in the market and potential causes for the decline. And when doing that, we see mainly two things that has affected the market in November. One of the things we believe is the deleveraging in Ethereum. So Ethereum prices has declined more than other assets in this market, more than, for example, Bitcoin. And I think it's due to the deleveraging happening in Ethereum. Last year, Ethereum went from around $100 or so in, I believe, May or April time frame to over $1,000 by the end of the year, and that was led by this ICO boom. And the market got overhyped. People bought into these ICOs with Ethereum, and now it's unwinding of those trades that is taking place in the Ethereum market. We like to follow tokendata.io for ICO statistics. I think they do a really good job looking at their data. We saw ICO raising some $10 billion or so during the past 12 months. In August, Token Data reported that ICO raised $508 million. That has come down remarkable since then. In September, the ICO market raised $180 million, and in October, $198 million. So coming from a level where we had an ICO market raising almost $1 billion per month, we are now at a level around maybe $100 to $200 million. I think September, October, November is probably flattish in terms of the ICO market. Actually increased a little bit in October versus September. So that deleveraging might be coming to an end. We have talked a while about Ethereum in a worst case scenario reaching double digit, and that just happened a week ago or so. I think it traded at 98 to 99 on Bitfinex or BitMEX. That has probably the decline in the and the deleveraging has probably been been also due to the SEC guidance. SEC said in the beginning of the year already that most ICOs are securities, and if you want to do an ICO to US investors, it's probably safe to do that under SEC security regulation, and that has probably led to this decline in the ICO market together with the general bear market in crypto. So I think that's the first big big reason for the recent decline, the deleveraging of Ethereum, and the second one is the hash war that took place in Bitcoin Cash. So if you haven't been following this, what happened last year in August last year, Bitcoin split in Bitcoin and Bitcoin Cash. Bitcoin Cash has a higher block size than Bitcoin. And what happened in November 15, Bitcoin Cash split in two chains, ABC and SV. And before that happened, one of the groups, Bitcoin SV, threatened to attack the ABC chain, and that probably led to some uncertainty, we believe. I put out a Medium post detailing how we saw this play out. As a hedge fund, we found an interesting trading strategy where we sold the future in Bitcoin Cash ahead of this fork. We could sell the ABC future at a premium to the spot market, and as that split unfolded, that spread between ABC and Bitcoin Cash widened a lot. So it was interesting ways to play that, and if you want to read the details on that, you can check out my Medium post from a few days ago. It's also on our website under our blog. But because of the threaten to attack ABC chain, there was a fear in the market that this hash war would be funded by selling Bitcoin. And I think that fear led to the big decline in the crypto markets the last couple of weeks. We saw the big decline actually starting when the so-called hash war started on November 15. We don't know if the groups behind ABC or SV sold Bitcoin to fund this war or not, but I think it was a fear in the market about them doing that led to the big decline that we saw in the market. We like to follow the development on ABC and SV on a website called cash.coin.dance, so you can check out their website if you want to follow what's going on with Bitcoin Cash, ABC and SV. The good news there is that CoinGeek, one of the biggest miners in SV, recently declared that they're not going to threaten ABC anymore. They're going to build their own community. So this is coming to an end. And if you look at that website, cash.coin.dance, you actually see that it is now profitable to mine ABC and SV. So miners are no longer wasting money on this meaningless hash war that actually never happened. It was just a threat. So this hash war is now over, and I think that's probably a good thing. So I think those are the two main reasons for the recent decline in November: the deleveraging of ETH, and we reached double digit briefly in Ethereum before going higher again, and the hash war, and that is coming to an end. Also, want to point out that we have seen this kind of declines in the crypto markets before. In 2011, the crypto markets fell by 95%. Of course, the market was much smaller then, smaller market caps, but the market was very volatile. In 2013, beginning of 13, the market fell by over 80%. And then we had the last bear market in 2014, early 2014, when Bitcoin was over $1,000, and it fell to, I think, $153 by August of 2015. That was an 85% decline. And that's about where we had the market now. The Bitcoin market from 20,000 to $3,500. That's around an 80% decline in Bitcoin. So we're probably pretty close to the bottom. It's very hard to time a bottom in these markets. But long term, we have a strong conviction. And as a fund, we need to scale in. It's very hard, again, to pick the exact bottom. No one can really do that. And it's usually not very liquid at the absolute bottom. So as a fund like ours, we tend to slowly buy into the market when we see these kind of declines as we have seen the last couple of weeks. I think that's the prudent way to operate if you have strong conviction for the long term. And that's exactly what we have been doing. With that, I think I'll move on to another couple of things. On the institutional side, we have seen some further development. If you remember, New York Stock Exchange and ICE, they said they would launch the Bitcoin futures in December of this year. That has been delayed to January. They said that they have overwhelming demand for that product. So they're planning to launch with this new venture called Backed in January 2019. The last few days, we also had Nasdaq confirming that they're going to launch a Bitcoin future product. Also in Q1, I believe in January as well. So Nasdaq will compete with New York Stock Exchange to launch a Bitcoin future. So these are, of course, regulated exchanges, and it brings cryptocurrency and Bitcoin more mainstream. We also, in the last week or so, we had another exchange product launch in Switzerland this time, a so-called ETP, exchange traded product. It's very similar to an ETF, and this time I think it's the first ETP that is tracking a basket of cryptocurrencies. I believe it's the top 5 crypto assets that the ETP in Switzerland it's tracking, and apparently the demand for that product has been pretty good the first days of trading. What else do we have? We have had some comments from the SEC in recent days about an ETF product. They would like to see, I think, more regulation in the crypto markets before they can approve an ETF. I think the ETF, again, with the highest probability to succeed is the FANEC SolidX ETF. That decision has been delayed, and they can no longer delay it beyond end of February. So we will get a decision from the SEC on that product before the end of February. I think there is a 50% probability or so that they will approve it. Maybe with the last few days of comments from the SEC chairman Clayton, that probability has maybe gone down slightly. It's a wholesale investor ETF with a minimum buy-in of 200,000. But we'll see what happens with that one. Also recently in October and especially in November, we have seen a lot more stable coins come into the market. These are stable crypto assets. That makes it very easy to move between crypto like Bitcoin and Ethereum to a stable asset backed by US dollar. in this case. You don't have to sell to fiat. You can trade to another crypto asset that represents US dollar. In this case, they have a US dollar typically in an escrow account, and we have seen a number of those launched recently coming from the US. They are regulated in the US. Those are Paxos, Circle, and I believe Coinbase is part of the Circle stablecoin as well as Poloniex, the exchange owned by Circle, and also Gemini has launched their own stable cryptocurrency as well. I don't know if we should really call these cryptocurrencies because they're not permissionless. They can blacklist addresses, etc. So they're more similar to fiat currencies. But anyway, it makes it easy to move from a volatile asset to a pegged asset and back again, which I think is great. Finally, a comment on some of the tech development, and then we can move on to Q&A. So if you have any questions, please put them in the chat. I think we will see some interesting developments on the privacy side. So privacy is a vertical we are really interested in when it comes to cryptocurrencies. I think we have seen a development over time in this space. I think Dash was one of the early privacy coins, and Monero as well. They use ring signatures for privacy. The next step in that evolution came with Zcash. They uses zero knowledge proofs for privacy, and they can provide absolute privacy using that technology. With things like Monero, there is still a probability that you can figure out where the transaction is coming from. They use a collection of signatures to try to hide the source of the funds. By the way, there is an interesting interview with one of the core developers for Monero in a recent Unchained podcast by Laura Shin. So have a listen to that if you're interested in these technologies. But I think what's interesting here is that we're moving into maybe a third generation of privacy coins, and it's based on a new technology. The problem with privacy coins so far is that both Monero and Zcash are very intense when it comes to bandwidth doing these private transactions. But now we are soon seeing a new technology coming to market called Mimblewimble, which combines scalability with privacy. So that could be really interesting. There are mainly two projects that people are following in this space. They're called Beam and Grin. So those I think should be on everyone's radar. Really interesting privacy technology there. On the tech side, we also follow closely the development with the Lightning Network on Bitcoin, and I don't think we have really seen any lightweight wallets yet, at least not for iOS. So I'm looking forward personally to try the first iOS Lightning wallets. As you might know, Lightning is a way to scale Bitcoin to potential millions of transactions on what we call a second layer, and it's still trustless, but it's mostly will be used for smaller transactions. So that's pretty exciting on the tech side. And if there are any questions, please post them now, because I think we're moving to Q&A. And if there are no questions, then we will see you at the next webinar next month. And in the meantime, I hope you follow our newsletter. If you haven't signed up already, you can sign up on our website for a newsletter. We send a weekly newsletter with some good content, hopefully every week. We do these monthly webinars, and in the meantime, you're always welcome to contact us per email as well. And we might have a couple of questions here. So we have one question from a Relaxed Human. STOs seems to be a major trend moving forward. Do you see an STO version of Ethereum competing with ETH as the new platform to launch STOs, or a dApp on ETH servicing this market trend? And then he lists a couple of projects there that are working in this area. Yeah, we think there are three major use cases for crypto assets. The first one is digital assets, and that's Bitcoin as a store of value, currencies, and it can be digital goods in games and so on. It's smart contracts and the open financial system. And the third one is the tokenization of real world assets. And STOs, I believe, is coming in that third bucket, the tokenization of real world assets. So that's an area where we actively invest in. We made a couple of investments so far in that area. And there are a number of projects we follow. Trust token is one, Swarm is another one, but it's an area we believe in. It's not as revolutionary as crypto assets because these are real world assets, not directly secured by the blockchain. So you need a layer of trust between the actual asset and the token. But we do see a lot of smart people working in this area. Harbor is one as well. Harbor just, I believe, launched yesterday or 2 days ago their platform. They are mainly geared towards real estate. So we're following Harbor, Swarm, and Trust Token. I think those are the ones we have seen so far. We think they might be able to build on top of Ethereum. So you can build into smart contracts whitelisting functionality. I think they're an ERC 1404 that is working with that, but there's probably other protocols as well. So you can build in compliance right into an open blockchain like Ethereum. And for it to be really interesting, I think it has to be on an open platform like Ethereum, and then you can build compliance on top of that. That's at least my thinking of it right now. Another project I'd like to mention working on in this area is 0x. So 0x is working on building in this kind of functionality into their protocol. Of course, they're working on a decentralized exchange. But that's a really interesting future. Also ties into the open financial networks. If you can bring in this all these real world assets, then we can expand the open financial system that is being built by projects like Compound, Dharma, and so on. And we can start doing borrowing, lending using these real world assets, which is pretty exciting. Okay, we got another exciting newcomer. In your opinion, is there a need for a preference to protocols over altcoins? Or are altcoins still good in your opinion, depending on the project? All right, so we really focus on the infrastructure, what we call layer 1 and layer 2. Layer 2 is also referred to as middleware, and layer 1 is the infrastructure where you actually need the crypto assets to run a network. So these are mainly protocols. There can be protocols for DEXs. Binance is working for On1. Protocols for smart contracts. There can be Ethereum, Definity, or for money, there can be the Bitcoin protocol. And you need the crypto assets to run these protocols. There's in the middleware stack, I think you have things like stablecoins with the governance token, like Maker in the Maker DAO. You have maybe file storage in that um, bucket as well. Um, you might have oracles. Maybe Augur can be seen as an oracle. That's an ERC20 token. Maker is an ERC20 token. 0x is an ERC20 tokens. So when we talk about tokens on top of a network, I think they can still have value. But I think you still have to be really careful in what you're buying. There are over 2,000 crypto assets, and most of them are actually these tokens on top of other networks, and 90% of them are on top of Ethereum. So I think you will have both. You will have fewer crypto assets used to run this decentralized blockchain at layer one. We think that we will have a future with maybe tens of long-term winners in that space. And then you have a middleware stack. And those can probably be built with ERC20 token as an example on Ethereum. And you will still have value there. And you might have hundreds of those kind of winners long term. I think the problem is that a lot of people created these tokens in ICOs just as a mechanism to raise money, and we don't see value in those tokens. That's the way we are looking at it. Okay, we have one more question. Pondering individual. If the sell down in ETH is coming to an end, does this mean it will steady at a lower figure? If there are limited ICOs, 10% of recent past, do you then see ETH recovering to any of the highs of the last 12 months? Could STOs come to ETH rescue? I think STOs are still early days. We haven't really seen any real STOs so far. There have been a lot of discussion about STOs for some time. ICOs, I think, has been the killer app for Ethereum so far. But we also see other use cases, like I mentioned, the open financial system that is mainly being built on Ethereum. I think at some point Ethereum will stabilize. We might have seen the low in the double-digit figures last week or so. The ICO market seems to be tracking along at these flat numbers for now at $150 to $200 million per month. So I think, yeah, we will see some kind of stabilization. Hard to see exactly where. And I think it's hard to see the ICO boom coming back anytime soon. At least not to the levels we had last year. But I think we will have other use cases as well. We will have digital goods being built on Ethereum. We will have open financial systems, and we will still have some ICOs. So I think we will slowly build our way back. It will also depend on if Ethereum managed to scale or not. We had some real use cases on Ethereum last year that almost that was too much for Ethereum protocol to handle. And I think Ethereum is still working on scaling solutions. So we'll have to see how that pans out, or if we will see a new platform coming to the market that will be exciting for developers to build on. Definitive is one of those that we follow closely that may be launched in Q1 of next year. We have one more. Maybe this is the last question. Happy one. What do you have conviction in long term? Which assets and why? Well, this is a great question. I think the space has huge potential. Money is one. Probabilistically, it's looking like Bitcoin will be the store of value in the crypto asset space, at least. We also believe in smart contract platforms, but we don't want to pick the winners per se. We want to build a portfolio with exposure to the project that has the best probability to win. So today in the smart contract platforms, A lot of people are building on Ethereum still, but we also see new platforms. I mentioned Definity a few times here as another platform coming online soon. We believe in privacy coins. Privacy is a fundamental human right, and that has value. We are trying to build a portfolio with this different privacy technology. We're not going to pick the winner, but we are building a portfolio with exposure to the potential winners. So as I mentioned, we have ring signatures, we have zero knowledge proof based privacy coins, and soon we will have a third version, Mimblewimble based privacy coins. So we are really trying to build portfolios here that has exposure to the verticals that we have identified as having the biggest potential. These are again the infrastructure plays like DEXs, like smart contract platforms, like store of value, like interoperability, like security token platforms. And then we are trying to pick in each verticals the projects where we see the biggest potential. And the potential comes from one technology, but also the potential of building the network effect. So that's in a broad view of how we're looking at